This is a demonstration of problem 18.1b, allocate transaction price upfront fees. American Cellular sells tablet PCs combined with internet service that permits the tablet to connect to the internet anywhere and set up a Wi-Fi hotspot. It offers two bundles with the following terms. Tablet Bundle A sells a tablet with 4 years of internet service. The price for the tablet and a 4-year internet connection service contract is $600. The standalone selling price of the tablet is $300 and the cost to American Cellular is $225. American Cellular sells the internet access service independently for an upfront payment of $420. On January 2, 2020, American Cellular signed 100 contracts, receiving a total of $60,000 in cash. So Part A states prepare any journal entries to record the revenue arrangement for Tablet Bundle A on January 2, 2020 and December 31, 2020. So we're selling the bundle of the tablet and the internet service for $600. So we have to determine the portion of the bundle that we're going to allocate to the tablet and the internet. Both the tablet and the internet sell separately. So to determine the proportion of the bundle for each one, we're going to use both of their standalone prices divided by the total of the standalone price. So to determine the portion for the tablet, we take $300, divide it by $720, and multiply it by $600, and that gives us the portion of the bundle for the tablet, which is $250, multiplied by 100 of these that were sold, gives us $25,000 of sales revenue for the tablets. We do the same thing for the internet. We take $420, divide it by the total of $720, multiply it by $600, and that gave us $350 allocated to the internet. Times 100 is $35,000 of revenue allocated to the internet service, and of course all 100 bundles sold for $60,000. The problem also told us that the tablets cost $225 each, so cost of goods sold will be $22,500. So now we can record the sale of the bundles on January 2nd, 2020 by debiting cash for $60,000, and we would credit sales revenue for the tablets of $25,000, and we're going to credit unearned service revenue for the internet service for $35,000 because at this time we have not earned any of the internet portion of the bundle. Then we're going to record the cost of goods sold for the tablets, which we would debit cost of goods sold for $22,500 and credit merchandise inventory for the same amount. At the end of December 31st, 2020, we would record 1 year of the earned revenue for the internet service. So the internet service revenue was $35,000, and these are 4-year contracts. So we're going to record $8,750 of earned service revenue each of the 4 years. So we would debit unearned service revenue for $8,750, and we would credit service revenue for the same amount. Next, we have a different tablet bundle B that includes the tablet, the internet service, plus a service plan for the tablet PC for any repairs or upgrades to the tablet or the internet connection during the 4-year contract period. This product bundle sells for $750. American Cellular provides the 4-year tablet service plan as a separate product with a standalone selling price of $200. American Cellular signed 400 contracts for Tablet Bundle B on July 1st, 2020, receiving a total of $300,000 in cash. So Part B asks us to prepare any journal entries to record the revenue arrangement for Tablet Bundle B on July 1st, 2020 and December 31st, 2020. So again, we are selling a bundle which is sold for $750. This time it's made up of a tablet, an internet service contract, and then a service plan. We do have standalone prices for all three of those. So we're going to use the proportional method to determine the portion of the bundle that we're going to allocate to each one of the components. So again, you're going to take the tablet standalone divided by the total standalone, multiply it by the $750, and that will give you $245 for the tablet portion of the bundle. We sold 400 of these bundles, so $98,000 would be allocated to the tablet sales revenue. You would do the same thing for the internet service and the service contract. Each of the standalones would be divided by the total standalone, multiplied by the bundle, and that gives you the separate amounts of the bundle for each of those, and you would multiply each one of these by $400 to get the total revenue for each of those, and then the total of all of the bundles, of course. $750 times 400 is $300,000, and the tablet cost is still the same, $225. So for 400, that would be $90,000. So now we can record the journal entry on July the 1st for the sales of the bundles. So we would debit cash for $300,000. We would credit sales revenue for $98,000. We would credit unearned service revenue internet for $1,360. $136,800, and we would credit unearned service revenue for the maintenance contracts for $65,200. We would credit cost of goods sold for $90,000, or debit cost of goods sold for $90,000, and credit merchandise inventory for the same amount. Again, the internet and maintenance contracts, none of that revenue has been earned in the beginning, so both of these would be recorded as unearned revenue. At the end of December 2020, we would need to record the internet service and service contract revenue that has been earned. For each of these, they have only been outstanding for half of the year. So first you're going to determine the amount. You would have to take the total amount, and then you would multiply that. You would divide that to get the yearly amount, $34,200 for internet and $16,300 for the service contract. But because these have only been outstanding for half a year, you would only record one half of that amount. So for the service revenue, we would debit it for $17,100, and we would debit the unearned service revenue for the maintenance for $8,150, and then we would credit the total to service revenue for $25,250. The C part states to repeat the requirements for Part A, assuming that American Cellular has no reliable data with which to estimate the standalone price for the internet service. So if you remember, in Tablet Bundle A, we were only selling the tablet and the internet service, but we had standalone prices for both of them, so we were able to use the proportional method. Now we don't have a standalone price for the internet, so in this case we're going to use what we call the incremental method. So in the incremental method, you use the market price or standalone price for the portion that you know, which we know that we would sell the tablets for $300 retail by themselves, and then you take the total bundle and you subtract what you do know, and the remaining amount is allocated, in this case, to the internet service. Then we would multiply each of those by 100 because we sold 100 bundles, and that means that we would recognize $30,000 for the tablets and the internet, and of course the total bundles were $60,000. The cost of the tablets is the same. So now we will record these, the tablet bundle A using the incremental method, we would debit cash for $60,000. We would credit sales revenue for $30,000, and we would credit unearned service revenue for the internet portion for $30,000. We would debit cost of goods sold again for the $22,500 and credit merchandise inventory for the same amount. Then at the end of December, we would need to record the amount of the internet revenue that we've earned. So you take again the total $30,000 divided by 4, and you get $7,500 of service revenue. So we would debit the unearned service revenue for $7,500 and credit service revenue for the same amount. And that is the conclusion of the demonstration for problem 18.1b.